Welcome to another edition of Learning About Loans. Today I have with me uh, Miss Tamara Podwalny, the great Tamara Podwalny. We've been together for a very long time. What's funny is it's been 25% of my lifetime that we've been together, which is crazy to me. Today we're going to talk about MCC. Yeah, you know me. Tell me, what is MCC, Miss Tamara?
It is a mortgage credit certificate.
All right. So for those that don't know, I don't know either. I know what it is in theory, but Miss Tamara, I know it happens. I know what it is. I know how to sell it, but Tamara knows how to do it. So Miss Tamara, what is a mortgage credit certificate? What is it? What's it do?
When you are a first-time home buyer, it allows you to get a percentage of your loan amount back on your taxes.
Loan amount or interest paid?
Loan amount.
Wow.
I'm sorry, mortgage interest.
Interest. Okay.
Based off the loan amount.
Based off the loan amount, right? So the interest you pay, some portion of that based on your loan amount is what comes back to you.
Yes.
So for first-time home buyers. So before we get into that, let's qualify first-time home buyer. First-time home buyer in the mortgage world is anybody that hasn't had home ownership in 3 years. So notice it's not, doesn't mean it's your first home to buy. It just hasn't had ownership in the last 3 years. So my question to you, Ms. Tamara, if I have two borrowers, do they both have to be considered first-time home borrowers, or just one person on the loan?
Just one.
What if I have three borrowers? Just one person has to be a first-timer?
Yes.
Cool. So one time, one person needs to have not owned a home. So just to be very clear on that, because we had a question on this yesterday at a seminar we did. If somebody, let's say Joe owns a home, Sally marries Joe later on. Sally lives in the home for 12 years, but was never actually on the mortgage and on the note, on the title. Title is the real key because that's the ownership piece. And it works. Sally technically is a first-time home buyer if she goes to buy a new home because she didn't own the home that she lived in for 12 years, at least not on paper. So that's a first-time home buyer. This is for first-time home buyers. You qualify. What do you do? So this interest you get back, how does that work?
So when you file your income taxes, they will give you 20% of your interest paid back as like a refund when you file your taxes.
Is it one and done? Like I get all that lump sum, or how's that paid?
No. It's so you'll get a 1099 every year from your mortgage company, and it's going to tell you the amount of mortgage interest that you paid each year. And on that 1099, it's 20% of that mortgage interest paid each year. And you can continue to get it for as long as you live in the home.
What about
own the home?
Okay, so just a bit, let's use some real questions. So if some are a real scenario, we'll keep it really easy math. Chances are you're going to pay a bigger number, but let's just say somebody for the whole year, they get their mortgage interest statement. So the 1098 says, hey, you made, or you paid 10 grand in mortgage interest, because maybe they got it, towards the second half of the year or whatever, it doesn't matter. So if they got this and they paid a total of $10,000 in interest, you're telling me they get 20% back, which is 2 grand, and they get 2 grand back. Do they just, I file my taxes and I get 2 grand just in my bank account, or it gets paid? How's that work? Do you know? Because I know technically just to be clear for those listening, we do the loan, all that stuff that happens after. I mean, certainly we know. And so I don't know if it varies based on how you file your taxes, but what do you know, based on what you know, what happens after that?
So when you file your taxes, you enter in your W-2 information, all of your deductions and everything. And when you start putting stuff in your taxes about your property, it's going to ask you if you've ever filed for this, if you are allowed to receive it. We do have to issue you a certificate at closing so that you can put that with your tax returns to prove that you did apply for it, that you are approved to get it. And so let's say you file your taxes and, oh, it looks like you're going to owe $500. Well, once you put in this credit, well, now you're getting back $1,500.
Because of that 2 grand based on the numbers I just gave you. So again, guys, to be very clear, whatever amount of interest you pay, it's 20% of that number. So again, I gave a random example of 10 grand. So Tamara's point is that 2 grand number goes to offset, in this case, if you were to owe money, and 500 in Tamara's example, that 2 grand gets applied, and all of a sudden you're getting back 1,500. Or if you were getting back $600, now you get back 2,600. And is that every year, Tamara?
Every year that you live in the home.
Freaking awesome. What
So
about if I
you move out of the
refinance?
home and turn it into a rental property, you no longer qualify.
Well played. I don't know that I'd ask that question. So yes, every year you live in the home. What if I refinance? So I got a house, I bought the mortgage, I got the MCC, I got the certificate at closing. A year later, rates go down and I refinance. I'm in a new mortgage. Do I have to get a new MCC or does it stick around? How's that work?
So you would basically request a new one, an updated one, because obviously your mortgage interest payments are going to change. So yes, you would get a reissue.
Reissue. So even though I'm not a first time buyer, because I'm now a homeowner, so do I still, it kind of stays with me. They just need to update it, it sounds like,
Yes.
to make sure that I'm still living there or whatever, make sure it all still works, I guess. Okay, cool.
Yes.
What about, so when I go to qualify and I'm trying to buy this home, and we'll say the annual, just to change our numbers, we're going to say the annual interest would be 20 grand, right? So we'll just say that in our example, they bought it, July 1st. So they paid the 6 months of interest to get the 10. So now we're going to say we lived there the whole year. They're going to pay 20 grand. So now it's 4 grand. We get back at the end of the year, 20% of that number. So if it's 4 grand, I'm going to qualify for the home. Does that help me qualify from an income or debt to income perspective? Does that do anything for me?
Yes.
What's it do?
So there's also a calculation where we can use, and we can put it somewhere, the link for the actual calculation, somewhere at the end of the video if you want. I
Yes,
can send it
please.
to you. But basically you take your loan amount and your interest rate and how many years you're going to live in the home. So I have it up really quick. So I'm just going to put a loan amount of 200,000.
You want to share your screen, or is your screen all crazy with all kinds of like sensitive stuff on it? Share your screen, because again, I didn't know if you had a borrower's file pulled up.
Okay. That's not it. How do I share?
Let me make sure you have access. Share. Multiple participants can share simultaneously. Try it now. Host. Should be able to do it. That work?
Yep.
Look at me. Look at us. Being all techie.
Share.
All right, here we go. Moment of truth. Wow, that's okay.
Which
That's
screen do you
your
see?
calendar. That's your calendar.
Oh, my calendar. There we go. Sorry.
All good.
Okay. So
Still the calendar.
you still see the calendar?
Still see the calendar.
Oh,
Vertical and squanched. So folks, this is how you know this isn't edited. You're in here living with us. There we go.
there we go.
It is very tall on the screen, but I do see it and it works. So I see the MCC credit. I see the T-Shack. I see the calculator. So it says your loan amount, 200 grand or whatever down there. Keep going.
Okay. And then we're just going to use a 7.25 interest rate, and the loan is for 30 years.
Cool.
We're going to submit. And this tells you what you can estimate your tax credit to be.
So year one, which is funny, it's not, and this wasn't planned, guys. So it's funny how that kind of worked. Year one, you save, or I guess the tax savings from MCC, to read it out there, $2,165 in year one. So that's how much they would get back. That's the savings. That's that 20% number. So my 10 grand wasn't too far off in our example, which is, total coincidence. Good for me. Cool. And then the 5 years. So what do you do? So you're the loan officer. You're looking at this. What comes next?
So now we're going to go to year one, and that year one is 2167.
Okay.
Well, believe it or not, because you're getting this refunded back to you on your taxes, we can actually use this as income for you. So we're going to take 2165 and divide that by 12 months.
And you can stop sharing your screen if we're done with it, but I like seeing that. That's really good.
Yep.
So 2165, I'm going to do it on you guys can play at home too. 2165 divided by 12 is $180 a month.
Yep. So we can now put that into the loan application under an MCC calculation, And that we can use that as an extra monthly income that will not affect the income eligibility limits, but it can be applied to help lower your debt ratios for qualifying.
That's amazing. So in other words, it helps you buy a little more house. Not that we're trying to push or steer anybody to buy a bigger house than they need, want, or can afford. But the reality is it does allow you that little extra room for, in this example, the $180 of extra in air quotes income, because knowing that that money is coming back to you in the form of the MCC credit once you do your tax returns.
Yep.
That's incredible. Tamara, tell me this: when, as far as programs go, can I use this with any program? FHA, VA, USDA, conventional? Does it have to be a bond? Like, tell me what this goes towards.
It can be used to any program as long as it is available. So it is a first come, first serve basis. So as long as there is eligibility with the program, you can use it. Right now, it has to be used in combination with another down payment assistance program. It used to be able to be used combined and standalone, but now right now it's only available combined. So you can use it with pretty much any TSHAC program, any TDHCA program, Shanoa. It cannot be used with the buyer's choice program that we talked about a few weeks ago. So you always want to make sure that you look at your program guidelines to make sure that they do allow for it.
That is, so first of all, a couple things in that, what she just said. Number one, Tamara's really smart and good at her job. So know that what she just said is, I understand, may not mean much to you if you're not in the business. So what she said, there's a lot of acronyms in there. Basically, at this moment, and it's subject to change, you could use the MCC for any and all, as long as you're a first-time home buyer. Nowadays, at this very moment of taping, it's only used in conjunction, meaning with another bond or grant or some sort of down payment assistance program. And the few that she listed, the ones that starts with the TSHAC, TDHCA, those are Texas loans. But the other ones like Shanoa, those are not, those are nationwide. So what I would say to this is, if you're interested in the MCC, here's the benefit about working with Tamara and the Mortgage Mark team. We know about it. Well, they know about it. And again, I could sell, obviously, but I could sell what I need to sell, but they know how to do it and how to calculate and all that fun stuff. But what a no-brainer to use. And it blows my mind, Tamara, and I think I know the answer. Have you ever not put an MCC in conjunction with doing a bond program? Is there any reason why you wouldn't do it?
They're not a first-time home buyer.
That's the only reason, right? But if they're eligible, do it. So here's the thing you need to understand if you're watching. The mortgage lender better know about it, and the mortgage lender better do it. Otherwise, they're literally costing you $180 in this example. And understand, guys, that was on a $200,000 loan amount. So if the loan amount gets bigger, that's a bigger savings. And it's really mind-blowing to think that sometimes we do, and I wish we didn't, we do lose business sometimes because somebody says, oh, you're 0.1 better, 0.1 higher in rate, or your fees are $500 more. Do you understand what Tamara just did? For the life of the time you live in that loan and in that home, Tamara's going to give you $180 a month on a $200,000 loan. So if you're working with somebody that doesn't know that, holy smokes, like that is such a big deal. So Tamara, I'm just assuming you tell me if they qualify for the program, that's just kind of an automatic add-on. Do they need to do anything to actually like get this or have this product or this program?
So as long as it's available, it's something that we will talk about adding on to the program. It does come with its own additional fees. The certificate itself is like $500. And then there's another small fee. So as long as it's available and you're a first-time home buyer, it's typically something that's talked about at time of application. So that some buyers don't want that extra $500 fee to bring to closing. So that would be the only reason. But
okay, I'm just going to stop you right there. And I'm sorry to interrupt you, but you're telling me somebody doesn't want to pay the $500 to get, in this case, $200 a year. Am I missing something? They just don't have the cash right now. Maybe that's why they don't have the $500 today to make it happen.
Yeah.
Boy, I hate that for them. So I understand, guys. I get it. There can be that scenario where somebody just doesn't have that cash to come up. So you said there was a fee, and I thought you heard you say one more. So is it more than the $500?
So there's $500, and then when you're using it in conjunction with the down payment assistance program,
Their
there's
fees,
an additional like $25.
whatever. Okay, so it's an extra $25. So really, it's $525 at this moment, subject to change, guys. So if it's 600 when you call us or whatever, understand that that can change. So at the end of the day, your lender better know about it. Your lender better make sure you're doing it. And obviously, you can bring it up if you're a first time home buyer. Make sure they do it. I would say beg, borrow, and steal $525 to make this thing work. And for qualifying, it's what's that?
I do want to also say, with some of our Texas programs, if you qualify, if you remember last year, we talked about Texas Heroes or Hometown Heroes.
Mhm.
The program's free for them.
So give me an example of the hero. I know him, but give me one or two examples.
Police officer, firefighter, veteran, nurse, teacher, librarian.
The hometown heroes, guys, like those folks, and God love you for watching this, and we truly mean it. Like, bless you, right? Especially the firefighters and the police department. I get to come to my job every day, not worrying about whether I come home tonight. So,
and they do have similar programs like T-Shack in other states. I know that Crystal, another member on our team, just looked at a program that's very similar to T-Shack in Kansas. And it's also something that that program offered as well. So it's something that is offered in every state. It's just in conjunction with that state's down payment assistance program.
Yep. So I understand we are in all, I think we're even in the Virgin Islands, for crying out loud. I didn't know that, but I think we were Puerto Rico, Virgin Islands, Alaska, Hawaii, Maine, Florida, you pick somewhere in there. And there are other programs. We're just throwing out the ones that we just have in our back pocket because we're here local, but we can do loans in all the states. If you have, again, we do all that. So when somebody calls for it, man, that's our homework. That's our job, is to make sure we're looking for those things. So, and if you know it, right, if you know of something, hey, I want to try this, because there's some that go into the county level or the township level or the mission, depending on what state you live in, where it's like, hey, here's what this city or this town or whatever is offering. Again, bring it to us. We'll figure it out. But the reality is there are so many. So don't think it's just for these products. That's, I think, Tamara's point here. It doesn't, again, $525 that's waived if you're the hometown hero or any type of program like that. It's a certificate. What about class? Do you have to take a class?
With any down payment assistance program, you are required to do that home buyers.
But it's not MCC making you take the class. It's the down payment or DPA program that's making you take class. Yeah. So if they do ever open this back up, how often does it run out of money? I don't think, truly, I think I just learned that today. That's the one that, not one thing, but it's probably the one thing or two things I didn't know. How often does it run out of money?
So besides when they suspended the program in 2020 for about 9 months because of COVID and rates dropping super low, this is the first time that it's been like suspended by a standalone product on its own, just because they have run out.
Yeah, the frenzy was so big, so much that they just ran out of cash to do it. It sounds like,
right. Since
and the government, because you understand, guys, this is taking money from our government, right? Yeah. This is our tax dollars that go in. It's helping folks and encouraging home ownership, and this is one of those sweet programs that, again, people need to know about. So if you got a first-time buyer out there, you're doing them a disservice if this isn't at least on the radar. And again, because it is program specific to the DPAs, and the DPAs, we have plenty of other learning about loan episodes where it talks about those. We're not saying the DPA is meant for everybody, but if you are, you better be using it. And that's the part I'd say. But Tamara, I love you so much. You're just so good and you're so great. I'm so glad that we're on the same team, because you were one smart cookie. What am I forgetting? Anything else that we need to suggest or recommend or talk about? I think we've covered it.
No, that's really it. It's super awesome. Simple and a great benefit to our clients. And we try to make sure that it's an add-on for all of our DPA as long as they qualify for it. Because why not do what's best?
Why not? You guys, again, Tamara, you're the best. Really, man. Thank you for watching out there in the world. And if you got comments, mortgagemark.com, reach out to us. Tamara's here. She can cross. I can certainly help, but you can tell she's the real guru. But appreciate you. And we'll see you on the next episode of Learning About Loans.